the record. So to introduce Professor Raghavendra Rao, for me it is kind of overwhelming. I cannot express his contribution to the research in just a few words written here. But he is enormous person for many of us in working in finance. So just to say a few things on the slides that he's Evelyn Rothschild Professor of Finance from Judge Business School, Cambridge University. He has held a number of different positions and posts across the world in Europe and in the US, UCLA, in Berkeley as well. And he is also a past president of the European Finance Association and past editor of financial management. What is more exciting is that he is also a founder and a director of the Cambridge Center of Alternative Finance and a member of the Cambridge Corporate Governance Network. He has published a number of papers in top journals from Journal of Finance and all those papers. And he received his IG Nobel Prize in the management of the in management of the paper. What doesn't kill you will only make you more risk-loving. Early life disasters and CEO behavior in 2015. And I think that paper was published in 2017 in Journal of Finance, if I'm not wrong. So over to you, Professor Rao, for your presentation. And for the closed caption, I think you have the co-host right, so you can have that.
I think you're the one who can turn it on, someone, no one else can.
Okay, I can do that, yeah.
Okay, so let me start sharing my own screen. Okay, so thank you very much for inviting me to talk at this. It would be very nice to have met in person, like we did a couple of years ago. But you know, sadly, that's not possible this year. So anyway, I'm going to spend a little bit of time talking about some of the issues which I think Bjorn already was talking about a few seconds ago, gender bias, all these issues. But I'm going to talk about it from a more general perspective, right? How do we think about trust in society as part of finance? So why is this an interesting topic? Right? It's a big topic, but why is it an interesting topic? Well, in the news, if you just read the newspapers over the last year or so, you have a huge number of articles that talk about things like stakeholder capitalism. For example, in 2019, there was this article in the New York Times which said that shareholder value is no longer everything, right? So a whole bunch of CEOs talked about that in Davos. Similarly, another article from the Wall Street Journal, is a big news everywhere. Unfortunately, as Babechuk and Farrell point out, they're really these guys, in spite of the fact that they have stakeholder statutes across the US in a whole bunch of different states, most of these people actually haven't done anything. They just talked a lot about it, but they haven't really done anything. So another big topic today is gender diversity, and we saw that an example of that in the previous paper. We have topics of ESG, CSR, climate change. These are all interesting topics which have only actually come to prominence over the last 2 or 3 years. Before that, nobody was actually doing any of this kind of work in say, the early 2000s. So what's common here? Well, the part that's common is a shift away from explicit to implicit contracts. Everything in finance has been around the idea of explicit contracts. Right? So we talk about hard economic incentives. How do you pay somebody? How do you structure the incentive plan? How do you monitor these people? And they're all based on hard data, numbers. In contrast, what we're talking about here are more soft behavioral incentives. How do you persuade someone to invest in ESG and CSR? What kind of metrics might you do? Can you convert soft behavioral incentives to hard economic incentives that they will do it if you give them enough incentives? So specifically, I'm going to talk about 3 different papers of mine. I try to condense them. One is how trust is actually evolving in finance. The second one is, when does trust matter? So I'm going to distinguish between individual specific trust and firm specific trust. And the reason is, as we'll see shortly, that we talk a lot about firms doing CSR and so on, but does it matter who the individual is who's actually doing the CSR? Or can anybody do CSR and get away with it? And finally, we'll talk about hard conversion of soft behavioral incentives to hard economic incentives, basically institutional pressure. So the first paper is a paper which is co-authored Peter Lembach and Henrik Sherman, when we look at the entire finance industry in the US. And what we find here is actually very straightforward. The question is, we know that the finance sector is crucial for economic development. Right? Better developed financial systems are associated with faster economic growth, higher levels of entrepreneurial activity, higher levels of innovation. That's all well known already. But for a finance system to be well functioning, you need to be able to rely on the contracts you write. You need to be able to rely on the contractors who are writing the contracts. But what's the problem? The problem is that you want to achieve a reliable contract. The way you do it is either through an explicit mechanism, regulation, for example, which court is actually going to have jurisdiction over your contract if the contract doesn't work, or implicit incentives, which are social norms such as trust. We all know that no contract can be written which covers all contingencies. So there's always something that happens when something, what happens when something happens which is not in the contract? This is a very important point. That's when you depend on the soft incentives. Right? So the question is, what is that evolution of implicit incentives, basically generalized trust in anonymous others, look like in the US finance industry over the last 40 years? So what do we find? Quick takeaway. We found that the level of generalized trust of professionals working in the finance industry has declined substantially over the last 40 years, both in absolute terms and relative to the general US population. Finance people have become significantly less trusting than the average US citizen. And this is unique to finance. We find it in no other industry. We don't find it in the healthcare industry. We don't find it in the tech industry. We don't find it even in the legal industry. Finance is amazingly interesting and unique. And in finance alone, that decline of trust is everywhere. It's not just the top, because if it was the top, you'd say, those guys will retire in a few years. The younger guys will come in and they'll be more trusting. No, it occurs across all hierarchy levels. So something about finance in particular. And we find three channels that might explain the decline of trust: changes in socialization habits, changes in general economic conditions, and the changes in professional environment in the finance industry. Quickly speaking, why does this generalized trust matter? What is generalized trust? What does that mean, actually? So the idea is that if you trust people in general, it facilitates economic transactions because it discourages opportunistic behavior. It means if I trust you, I'll be more willing to cooperate with you, right? And because trust is reciprocal, if I trust you, you trust me, and that increases my trustworthiness as well. So I respond better to trust, and I give more trust to both people. And of course, you don't need, if you trust the other person, you don't need costly monitoring, you don't need legal services, you don't need enforcement of government regulations. However, in finance, it matters, right? Because the products which we as finance people sell are increasingly complex. The services are very opaque. Most of us have no idea what a finance contract looks like. And these interactions between people who are unfamiliar with the concepts of finance and conflicts of interest are very, very common. And so, to put it, Luigi Zingales put that a few years ago, says the finance industry provides services that most people need, but few people understand. So making the potential for information asymmetries larger than in most other industries. And over the last half century, the US finance regulation industry has been more and more deregulated over time, which means there's nothing controlling these people in the form of explicit contracts and explicit regulation. So you do need trust more than ever to constrain their behavior. So where does the data come from? Well, the data here comes from the General Social Survey, the GSS, in the period 1978 to 2016. It's a nationally representative survey, about 1,500 respondents each year. And from 1994 to 2016, there were 2,800 every second year. And the trust measure is simple. If they ask people, generally speaking, do you think that most people can be trusted or that you can't be too careful in dealing with people? Right? And people answer, most people can be trusted, other, or it depends, or you can't be too careful. And we adjust the data. I mean, there's a lot of problems with this data. So, Black people were oversampled in 82 and 87, the interviews in Spanish, and things like that. So we drop all that stuff. These are standard adjustments. But when you do that, you look at people who answered that survey within finance and compare them to people who answered that survey who are not in finance. So within finance, that is basically credit intermediation, securities, and the insurance subsectors. Those are the three major subsectors we find. About 5% of the respondents work in the finance industry. And what do we find? Well, roughly speaking, this graph tells you everything. So the red line here shows you how residual generalized trust evolves in finance. As you go through the years, it dropped. Initially, in the 1970s, people in finance really trusted each other more than the average population. The number crosses in the 1994 period, and after that, it is well below the US population. And that difference, as you can see, the time trend on the right-hand side has been slowly declining over time. So empirically, how do we show it? Well, we just run that regression where we say trust as a function of whether you're in finance or whether you're not in finance, and a whole host of control variables, right? So the trust variable is a dummy variable, which takes value 0 if you say, yeah, most people can be trusted, 0 if it says most people can't be trusted. And so finance, not in finance, standard stuff, right? What are the control variables? We look at your race, we look at your gender, we look at your age decade, we look at whether you're a US citizen. We have a whole bunch of socioeconomic controls. What's your highest degree? What's your full-time and your part-time employment? Everything you can think of, we dump it in there. All right, so let's look at the basic results. If you ask people, do you say most people can be trusted? The first line here shows actually all the numbers are negative. Right? So you notice that if you run an OLS regression, whether you're looking at in finance or not in finance, people are just generally trusting other people less over time. This has been well documented. What has not been documented is the difference in time trends between finance and non-finance people. As you can see, finance people are significantly less likely to trust other people than non-finance people. Okay. Quantitatively speaking, it's equivalent to moving from the least racially fragmented area to the most racially fragmented area in the US in the 1990s. Well, we did see a change in that graph. Remember, in the beginning of the graph, we had these people trusting in finance were high above the people not in finance, and later the drop below. So let's look at the different sub-periods. It doesn't matter. The decline was higher in the beginning, but it still persists even in the later period. That means the decline in trust has been negative relative in both sub-periods. What about other industries? Well, if you look at healthcare, legal services, tech firms, you find absolutely no difference in the between these industries and people not in these industries. In fact, the tech industry, you find the opposite effect. People trust the tech firms more than they trust non-tech firms. What about different sectors in finance? Well, if you look at across the board, banking, yes, it is significant, but not at the upper echelons. The upper echelons are the same. But for the others, we look at the investment and insurance industries, the industries which really deal a lot with common people and are, sell a bunch of opaque products. It doesn't matter whether you're looking at the opaque or the upper echelons or anybody in finance. People in finance trust people, other people, general people, less in investment and insurance. Well, why is this happening? Well, one of the things that's happening, which is contributing to this, is the fact that we ask people, who do you trust? I mean, not in general others, but what institutions do you trust? And what we find here is if the finance people trust other parties relevant to the finance industry, much less. So in other words, they don't trust major companies to do the right thing. They don't trust the executive branch of the federal government. They don't trust Congress. They do trust the military, the press, the scientific community. That's all the same. Nothing else changes. But the companies, the parties that are especially relevant to finance, the trust has gone down the most in all of them. Okay, so why is this happening? Well, one thing that's happening is finance people don't talk to other people. So when we look at the number of working hours finance people have, they work much more than relatively non-finance people. Group membership they are much less likely to belong to a group than non-finance people, social group. And of course, they're much less likely to belong to a Putnam type group. They don't go bowling together. They don't play organized games together. They don't hang out with other people. So the changes of socialized happen is also unique to finance. Not the healthcare industry works equally hard, but they don't socialize less. They do hang out with other people. Finance people, for some reason, do not. Okay, economic conditions, same thing. If the worse the economic condition, the more likely it is that people in finance will say, I'm sorry, I'm not getting my share of the pie. I don't trust anybody. I want my share of the pie. And finally, changes in the professional environment. If it turns out that if you look at the environment in finance, the professional environment in finance, the number of non-white people has increased in finance over the period. The number of highly educated people has increased, and the number of females has actually decreased over time. But as we find that the proportion of non-white fraction in finance, people coming in who are not like you. So you say, I'm less likely to trust these people. So overall conclusions from that paper, it was the first paper to look at this generalized trust of individuals in the finance industry compared to the average US population and to show how that time trend evolves. And what we find is over the last 40 years, the generalized trust of individuals in finance has significantly declined, much more so than the average US population. And it's unique. Something in finance that's not there in any other industry. And we identified three non-mutually exclusive channels. Number one is a reduced opportunity to generate social capital, growing income inequality, and racial fragmentation within the finance industry. So that's one paper which looks at trust in general. The second paper looks at individual trust. So in this paper is co-authored with Zicheng Lei from King's College, Dimitris Petmezas and Chen Yang, both from Durham. And we look at when do companies do CSR? So the basic question here is, we know that CSR is becoming increasingly important concern for managers and investors. But does it create value? Well, if you ask people like Linz, Henri Servais, and Anik Tamayo, they say yes. This is really important, right? If it turns out, for example, during a financial crisis, if you're doing a lot of CSR, people trust you more. CSR is good because people will help you out when you're in trouble. But a lot of other people say, no, that's not true, because this gives you companies an opportunity, CEOs an opportunity to extract value from the firms, which, is kind of like an agency cost. None of these people have actually asked, does the identity of the person doing the CSR matter? And we know that individual identity characteristics do matter for CSR. For example, Conquest and you and DeJulian Kostowetsky find that, if you have a daughter, as Conquest and You's paper, you're much more likely to do CSR. DeJulian Kostowetsky find that democratic managers are much more likely to do CSR. But they don't examine how does it create the value created by CSR. What do we find? Very straightforward. Again, if you're a home CEO, somebody who manages a firm that's located within 100 miles of their birthplace, they undertake significantly higher CSR activities in their local communities relative to non-home CEOs. Actually, hold on a second. I see a couple of questions here relating to the previous paper. That's a good point from Salma. The general public doesn't trust people in the finance sector. So, and of course, the media portrays this as cutthroat, self-serving individuals. So yes, there's no causality in that paper. So it could well be that, you are one causes the other, and then there's a feedback effect. We don't have an answer here, but it is entirely possible that people trust finance less. Teresa, thank you for pointing me to that paper. So that paper is definitely very valid. Right? I'm also happy to take any other questions relevant to the first paper. Salma?
One thing that I can maybe add, I mean, it's not related to the paper per se, but an observation is that at university, in business schools, we don't really teach ethics and kind of behavior that is not opportunistic. We teach them capitalism, we teach that a shareholder is the most important individual in the company, and we need to increase profits and so forth. So we're kind of helping create this what exists now in the finance industry. So I don't know what the solution may be, but what can we do as educators to cut this trend, I guess?
That's a very good question, right? I mean, and that's actually very true, because the major problem with teaching finance and accounting is we're used to measuring, right? We're used to metrics. And the problem with trust, another thing, is developing metrics is really difficult. For example, and I'll talk about this in my last paper, when we talk about external pressure imposing some metrics on some companies versus another, it only works in some areas of the world. It doesn't work in other areas. So when we talk about issues like social justice, what might be social justice in America and in Europe may not be social justice in Africa or in Asia, right? And so we can't even define a common set of metrics around the world. So in my own classes, I try to emphasize that, valuation is not everything. Right? We focus on valuation, but in the end, it's a human being which has to make that judgment. So you do have to figure this out. So it's a very good question. And I think we're just at the beginning of this right now. Remember, none of these areas was really, nobody was investigating any of these 5 years ago. Right? So it's a very, very new area of finance. So hopefully we'll get there. Right? Okay. So coming back to this one about who does CSR, what we find is if you're a home CEO, that means somebody who's born and brought up in a place. They manage firms located in the 100 miles of birthplace. They undertake significantly higher CSR relative to non-home CEOs. And what's more interesting is this is a large effect. It's about 7% of the median firm's net income. To put that into perspective, the CEO daughter effect is about 10% from Conquest and You. The CEO political preference effect is about 9.3%, so exactly in the same ballpark. And what we find is if you are a home CEO and you do CSR, you have significant increases in firm value. If you're a non-home CEO and you do CSR, there are no changes in firm value. So what it turns out is it's not just doing CSR that matters. It's how that CSR is perceived by the local community. If you're a local person, people say, oh yeah, he's a local boy or a local woman, but most CEOs are male, so I'm using the low term local boy does good as the title of the paper. Anyway, the point is that local customers, we show in this paper that local customers, supply and employees react positively to CSR activities, right? So it's a local guys who say, oh, this is a local CEO. I trust this person because that identity, that person cannot shed. We'll talk about that in a minute. And we have no evidence that CEOs derive private monetary benefits from any of these activities. Okay, so why do local stakeholders trust home CEOs more? To explain that, we actually develop a new idea here. And the idea is something called place identity, and to differentiate it from place attachment. Jonker talks a little bit about this, but he doesn't actually do anything with this. The idea is, where do you feel you belong? Right? That's your place identity. It's something which is not under your control. It's an exogenous characteristic of the CEO. Your parents shows where you were born. Your parents shows where you were brought up. So that place identity is something which is difficult for you to change. But place attachment, you can change. I've lived for 10 years in Cambridge. I really like it. So I'm attached to Cambridge. But do I identify with Cambridge? Do I feel that I am a person from Cambridge? Do I feel I'm a person from India? Do I feel I'm a person from San Francisco, which is where I was a few years before I came here? So, that's a different question altogether. Place attachment, you can develop. It's endogenous. Place identity is exogenous. So what does the prior literature say? Well, we know there's a huge literature on birthplace bias, right? It affects employment policies, compensation packages, the works. Our contribution is to show that birthplace is just not, what is the underlying economic mechanism is your place identity, not whether you're attached to a place. And we'll show you that in a different. There are a whole bunch of papers talking about determinants of CSR activity. And what we show here is that managerial incentive design to increase or reduce CSR that is basically put into place by the shareholders of the board of directors will not necessarily work if they do not consider the idiosyncratic CEO characteristics that might motivate them to do CSR by themselves or demotivate them from doing CSR. Does the CSR benefit firms? There are two types of literature, right? One basically says there are types of CEOs who invest more in CSR, and we talked about some of them already, but there's no examination of the effect on firm value. There's another bunch of papers that talk about firm value, but they don't have an examination of what characteristics the CEO drive it. And anyway, the results are mixed. Friedman says no. Surveys and Tamayo, Flammer, Surveys, Linz and Tamayo, all these other papers say positive, but it's firm specific. That means anybody working in a firm can do CSR, people will react the same way. And what we show is, well, it's not firm specific, but individual specific. And finally, we contribute the literature on idiosyncratic CEO style. And that's important because there's a whole literature which talks about some styles matter. What we're trying to say is maybe your place identity versus place attachment tells you what style will be important where. Right? So that's something which might be useful for the literature for going forward. Where does the data come from? Execute Comp, 1992 to 2016, exclude financial firms, take the KLD database, we have CEO geographic information, collect the birthplace data from Marquis Who's Who, Standard & Poor's, the standard stuff. Right? And we call the person a home CEO. The distance between her place of birth and the headquarters is less than 100 miles. And the final sample was 963 unique CEOs in 703 firms. So, do home CEOs carry out more CSR? We have to measure CSR. So we look at the raw score and the adjusted score. These are standard measures in the literature. The CSR score measured by KLD. Okay, what's the regression? Well, it's a pooled OLS regression where you simply regress CSR score on home CEO and a bunch of other factors. So there's home CEO, remember, is the distance between your home and the CEO's headquarters, company headquarters is less than 100 miles. This robust multiple ways of doing it. Firm controls, CEO controls, and then industry, country, industry, county, and year fixed effects included. We don't have CEO fixed effects because most CEOs don't move from one firm to the other. You become a CEO and eventually you retire. So there's no firm movement of CEOs, so you can't include CEO fixed effects. Okay, quick univariate statistics. If you can see, the home CEOs are about 30% of the sample, 27% of the sample. Jonker finds that home CEOs in his sample were 30%, so in the same ballpark. But Home CEOs are more likely to stay longer at the firm. They're more likely to own more of the firm. The firm is less likely to be a glamour firm, and the firm is more likely to have a higher CSR score, exactly as we would think. So first, look at the levels. Putting into place all the other regressions, what we're saying is, does being a home CEO increase CSR? The answer is a clear yes, and significant at the 1% level. Okay, in economic terms, what this means is, the CSR rating is about 4% higher if you have a 1 standard deviation in the home CEO place. Is this economically important? The answer is yes. It turns out you are spending about an extra $13 million on CSR relative to a firm with a non-home CEO. That corresponds to about 7% of the median firm's net income. Remember, the CEO dollar effect was 10%, and the political preference effect is the political preference effect was 9.3%. There's a question in the chat says, how do you classify where you have many MNCs in the headquarters? The answer is we don't, because we're only looking at US data. So this is just US companies alone. We do look at foreign CEOs coming from outside the country to manage companies within the US. But we find, again, there's slight place attachment. They're not really one of the local people. So there's no difference in those results. Another question in the chat at this time is, are they related to cross-listed companies? No, again, the answer is, again, remember, they have to be US listed. So they could be cross-listed. We don't care. It's not there. We don't check that data in the sample. Okay. One possibility might be that CSR is just a form of marketing. So it's just, correlated with advertising. Well, so you take out marketing from SG&A expenses, you still find the same thing. Higher CSR score, higher SG&A minus marketing. Maybe CSR boosts your sales, normalized by sales. You still find the same result. Okay, what type of CSR do these guys do? Well, they do everything. Community, environment, diversity, employee relations. The only thing they don't do is human rights, because human rights is more big, non-local community related. So putting it in a different way, we run it for each of the subcategories. What do they do? Well, in community, they give more money to charity. They have less negative economic effects on their communities. They focus on recycling. They have few concerns on hazardous waste, regulatory problems, land use, biodiversity. They promote more female and minority employees. They hire more disabled individuals. They treat their employees in a fair manner. Few concerns on workforce reduction, high strengths on employee employment. And they have few concerns on union relations, supply chain controversies, and child labor. So they seem to be doing exactly what the local community values. So then the big question becomes, wait, is it firm specific or is it individual specific? If it was firm specific, then anybody coming into this company and staying an equally long period of time would have the same effect. So what we do now is to say, how long were these people in that same area near the headquarters? So if you're greater than or less than the median. So this is home CEOs, this is non-home CEOs. It doesn't matter how long you spend. Controlling for the length of time, home CEOs have significantly higher levels of CSR than non-home CEOs. And if you run a regression with this as a continuous variable, home CEOs have a significant higher variable, higher relationship with CSR score. Non-home CEOs do not do CSR, regardless of how long they're spent in that area. Okay, what about the strength of CEO home connections? Well, did you, not only were you born there, but you attended a home state? Yes, it's significant. Right? Home state college or university. Where you stayed there for a very long period of time. Yes, that adds to your CSR effect. Did you have a hometown board position? Yes, and that adds to the CSR effect as well. Right. So then the question becomes, is it the CEO or something else? Well, we look at changes. What happens when a CEO, a non-home CEO, is replaced by a CEO? That's a good question, and I'm going to talk about Christina's question about family companies. We get rid of family founders, same effect. right? It doesn't have to it's not related to family firms. Anyway, we look at non-home versus to home, and you notice that if you go from a non-home to a home, significantly positive increase in the level of CSR. From a home to a non-home, significant negative change in CSR. If you go from non-home to non-home, there's no change. From home to home, there's no change. Okay, what about the headquarter changing? If you move if you're a home CEO, you always produce more CSR. But if you move closer to home, you do more CSR. So the next one is, what about corporate culture changes? Corporate culture is, well, the firm is changing. So they fire a CEO and replace that CEO by a different CEO. So it's not really CSR driven by the home CEO, but by the corporate culture in that firm. And the answer is, well, if you look at any of the measures, this is based on Kylie's paper in the RFS, so we got her data. And if you run that regression and interact home CEO with all the cultural variables, the home CEO effect continues to be strong, but all the interaction terms are insignificant. Then, of course, you have the problem of indigeneity. So indigeneity is, well, maybe I want to implement CSR, so I don't know what to do. So I interview all the CEOs, and the local CEO guy, the home CEO guy, is much more articulate about CSR than the non-home guy. So it's a firm which is trying to get CSR and uses a home CEO as a better way to implement that. So that's reverse causality. Second, of course, is omitted variables. So how do we deal with this? Well, there's two ways. One is, of course, your PSM. So when you do a PSM, you're running a whole bunch of, before the PSM, you notice that all the CEO variables we have over here, we also have two variables related to the state level variables. So richer states or states with lower unemployment may need less CSR than companies located in states with lower GDP or higher unemployment rate. After PSM, nothing is significant, right? So there's no differences. And once you run that regression, notice that the CSR score continues to be positive for home CEOs versus non-home CEOs. The second one is an IV. What's the IV? The IV is, what's your hometown? Did you have a hometown board position prior to becoming CEO? The instrument there works because we're saying, look, I might say, I want to hire this guy because he has a hometown board position, so he knows other companies in that area. But I'm not hiring him because of that level of CSR they're doing at that company. I mean, I'm not hiring him because the hometown company has a different level of CSR from my own. I'm hiring him because of the hometown board position he has. And when we run that regression, so this is an instrumented first stage, instrumented second stage, and we find the instrumented home CEO continues to be positive and significant. So now the effect on shareholder value. Home CEO into CSR, positive and significant across the board. Tobin skew in year T plus 1, year T plus 2. And then what about a mechanism? Well, we look at the dependent variables, which is customers, suppliers, and employees. Home CEOs have significantly positive effects across all of them. So the local people like home CEOs. Fine. But how does it actually impact your satisfaction? So we're now looking at the CSR by home CEOs. It turns out that you can charge local customer a higher gross margin, but maybe the sales are lower. No, the sales growth is also higher. So local customers are willing to pay more for your products because they know you're a local boy. But non-local customers, there is no effect of CSR on those people. The second thing is employee. Well, if you look at the local employees, the CSR increases the sales per employee, improves the productivity, and improves the employee growth is much more than if you look at non-local employees. There's no effect on non-local. So it's the local stakeholders that are affected by CSR, not the non-local. Finally, the financial crisis. So the financial crisis here is straightforward. So it's a dummy variable that's set to 2008, 2009, and post-crisis is after the crisis is over. The idea is investors see that you're capable of managing CSR, managing your local employees very well, so they trust you more when you get into a financial crisis. The answer is, whether you look at raw or abnormal returns, for home CEOs, there's a positive effect. For non-home CEOs, there is no effect at all. Well, another crisis which we have just been through, is going through right now, is of course the COVID pandemic. So you run the same thing for the COVID pandemic. So you have the COVID-19 period or the post-COVID period. I'm calling it post-COVID, but we don't really know what post-COVID is. So, but it doesn't matter. You notice that whether you're looking at pre-COVID or COVID or post-COVID, there's always a positive effect for home CEOs and CSR, but for non-home CEOs, it's a negative effect. So even with the latest pandemic, you find exactly the same results. Is it agency problems? Well, you take the standard agency measures, the entrenchment index, run the interaction terms with the entrenchment index, institutional ownership, independent director, nothing shows up. What about if you look at, do these guys get private benefits from CSR? Do they, for example, leave the company and take on a political position? Well, it turns out the answer is no. They don't take on a political position, and either before or after they become the CEO. There is no effect on that. They do contribute more to local politicians, but you could talk about that being good citizen. I mean, it doesn't mean that the guy is actually, bad for the company. And do they get monetary money benefits from CSR? The answer is no. It seems that the CSR score is unrelated to compensation, either equity or total compensation. So these guys don't actually get anything other than doing good. And of course, a huge bunch of robustness effects, including the founder CEO effect over here. So we get rid of, for example, look at master's degrees, we eliminate the top 3 bound countries, we change the control for industry, we look at a firm fixed effects model, political affiliations, you name it, we do it. And the results are robust to all of these. So our conclusions overall is your identity as a person affects your activity as a CSR activity as a firm. And it's not a place association story. If I was not born in the place, but I just moved to the place, I don't find much of an effect on CSR. These guys don't do much CSR. And when they do, it doesn't have an effect on the value of the firm. So the effect of CSR is also not just you doing the trust generating activity, but how that trust generating activity is perceived by the local stakeholders. If they don't think you're serious, if they think you're just an outsider doing your standard stuff, it doesn't mean very much. So, for example, DiGiulio Kostowski said that CSR has adverse financial effects from firms, and that's why not everybody does CSR. We say that's not true. If it does not have adverse financial effects, if it's done by CEOs who are more likely to be trusted by the local community. Engaging in CSR is not a sufficient condition to create value. Place identity matters because it's something you cannot change, and that's why people trust you. So that's paper number 2. I do have time for a couple of questions at this stage, so before we go to the last paper. So
if you allow me, if I go back to your trust paper, sorry, that time I couldn't get time. So when you say that if I trust someone and if the other person reciprocate the same, then the trustworthy appears in the relationship. Now, over the times, it also depends on, if I know a person for a long time, then again, the trustworthiness, the degree of trustworthiness increases or decreases for whatever reason. Now, when we have the data and we run OLS or probability regression for a binary model or so, then we can capture just the average effect of that trustworthiness or so. Therefore, over the time, how can we then measure and see the effect on finance or non-finance people in that scenario?
Okay, well, you mean the first paper?
Yes.
Okay, sorry, I was thinking about it from the point of view of the second.
Sorry, I'm going back to your first paper, yes.
Could you repeat what you said? You messed up in the middle, so I couldn't quite get exactly what you were asking.
What I'm saying that when how do we measure the trustworthiness or the degree of trustworthiness over the years? If two-person, finance or non-finance person, they know each other, say in a first year or after 10 years, the amount or the degree varies over the time. Then how do we capture other than QLS or simple, say, non-linear model?
Okay, the started survey, we use the general social survey. That means it only captures trust in anonymous other people. We don't have a survey that says, do you trust people in finance? I think Renee Adams has a paper which looked at, do people trust finance? But that's a separate survey. It is not for a very long period of time. It's a very short period of time. So she has some data on that, but we don't have enough data to ask that specific question. Right. So this is a generalized survey which asks about everybody in the world kind of thing. Do you trust an anonymous person?
Oh, okay. All right. So since we do not have much time left, so if you can complete your paper or present your paper within, say, 5 minutes, then we can have 10 more minutes for question and answer. So we have time until 11:15.
Okay. Let me quickly summarize what I'm going to do in this one here. So the final paper looks at external pressures, soft incentives to do the right thing versus hard incentives with institutional pressure. So this is a quick summary of what we're doing. It's a paper co-authored with Jason Sandwick from Tulane and Thierry Vermaelen from SEAG. And what we're looking here is at board gender diversity and IP underperforming. So what motivated this paper is actually an article which was published in The Hill on 23rd of January, 2020. And the article said very simply, Goldman Sachs CEO David Solomon said that the investment bank will only finance IPOs for companies that have at least one non-white male member, at least one non-white, male board member, that means, person has to be either non-white or female. And so he said in his subjectivity, he's not going to take a company public unless there's at least one diverse board candidate with a focus on women. And he said this diversity in board is very important. We've been focused on it. We've been trying to find ways to change that. It's a small step. There's a step in saying, you know what, we think this is right. We think this is right advice. And we said, okay. The problem, of course, was he said only for IPOs in Europe and in America. So what's wrong with Asia? Why would you not do gender diversity in Asia? Is not important there? What about Africa? What about Australia? No, it's only in Europe and in America they do IPOs with at least one female member. Another thing was posted by NASDAQ also in the same month, January 2020. And they filed a proposal with the SEC to adopt Rule 5605, which said that you have to have at least one director who self-identifies as female, at least one director who self-identifies as Black or African-American or all these things, or explain why you do not have at least two directors on the board who self-identify in these categories. And they basically said, we have 20 studies which show that having diversity on your board increases firm value. So when we read that, we looked at those studies, and all of those studies were practitioner studies. There was no academic study which actually has shown that diversity increases firm value. So what is wrong with the practitioner studies? Well, they look at survivors, right? So they look at the companies in today who impose diversity requirements on the board in the past, who had diversity on the board in the past, and they say, how did these companies do over time based on the information we have today? But companies that put in their board women on the board or were gender diverse on the board in the past who didn't do well are not in the sample. So obvious survivorship bias, but so he asked the question, what's the economic impact of board gender diversity on the performance of initial public offerings? So why IPOs? Well, it's the only transaction where investors can express their opinions on the value of the company. Right? In a merger, you don't ask people, what do you think is the value of this company? IPOs you do in the part of the book building process. And the investment bank has an outsized impact on the terms of the offering. If Goldman says, I'm not going to take you public if you don't have a woman in your board, how do you go public? Right? I mean, it's not just Goldman, but let's say all the other investment banks follow Goldman's lead. You just can't go public. So you are almost a statutory requirement to do this. And of course, we don't have, IPO underpricing. You remember, is bad for the firm. So you can't basically say these guys are putting women on the board to get underpricing. It's not endogenous. But with every other study, it is, if you put people on the board, it's endogenous. That is, more successful companies are more likely to be diverse, but not in an IPO, because you're looking at something which is actually bad for the company if there's underpricing. So why might diversity be related to underpricing? We looked at two hypotheses. The value-added hypothesis, which says maybe, women add value. They're less risk-averse than men, maybe. So maybe males are overconfident. This offsets each other. Maybe there's less groupthink, right? These guys are all thinking about it, thinking the same way. Now women are there. They're better at articulating issues than men. And it's a positive signal for the firm's ability to attract a diverse set of employees, they attract customers, and so on and so forth. But it's also investor demand hypothesis. That is, some investors are saying, we want diversity. I don't really care about risk value or not. Diversity is good. We want you to do this. And so the empirical implications are straightforward. If you have a value-added hypothesis, that means that you have higher operating performance. If the market is efficient, then it should be in the pricing. If the market is not efficient, it should show up in the long-term stock returns over time. But again, the problems here are endogeneity. The more successful IPOs might be the ones who are making more gender diverse firms. In contrast, the investor demand hypothesis just says investors are willing to pay a premium for this. So you want to persuade them to reveal that information. You have a bunch of private information models, Ben Venice and Spink, for example, who say investment bankers underpriced to persuade these investors to reveal their private valuation for gender diversity. There are also partial investment model. Inche, for example, has a paper where it says that investment banks don't really understand anything about gender diversity. They don't talk to women. So in part of the pricing process, they don't adjust for it. There's sort of ambiguous implications for performance. We don't really know how it's going to do. For example, if the first day returns don't reflect diversity, maybe you make money by buying it after the first day. And in the future, in the long term, maybe that demand for diversity could be, people are overpaying for the IPO, so the long-term return could be negative. We don't know. Anyway, what we find is straightforward. We find evidence in favor of the investor demand hypothesis. That is, gender diversity is positively, significantly related to underpricing on the issue date. It's economically meaningful and significant across the entire sample period, but it's driven mostly by IPOs in the most recent decade. From 2010 onwards, when diversity became a big issue for many US companies. The SEC actually had a rule put into place in 2009 that said, if you do not have a gender diverse board, you have to explain why. So I think CalPERS and Facebook went public. That was one of the things people were arguing that they should have women on the board, but they didn't. And it turns out that the gender diverse board IPOs have 20% more underpricing than non-gender diverse boards. And so by not considering the demand for diversity at the opening, gender diverse board leave about $28 million on the table. And after the stock is publicly traded, there is zero difference between these firms and non-gender diverse firms. There is no effect whatsoever. So here's the effect on underpricing. We're looking at the first day returns. So this is for in the overall period. This is for 2010, 2018, and here's a relationship between gender diverse board times interacted with the post-2010 period, highly significant in the levels of underpricing. However, this doesn't show up anywhere else. So it shows up in money left on the table, sorry. So much more money left on the table. But it doesn't show up in short horizon performance. It doesn't show up in long horizon performance. It shows up in institutional investor holdings. So in other words, more diverse you are, and the more in the post period, you're significantly more likely to be owned by institutional owners, in particular, the big three, State Street, Vanguard, and BlackRock, which are the three big companies which have been placing a great deal of emphasis on this. Conclusions here. We have a lot of institutional investors today who are placing emphasis on these non-financial factors, right? Diversity, inclusion, CSR, ESG, all these factors. This matters in corporate financing because large institutional investors, maybe others, believe it's important. May not directly be related to firm value, but it's important for the financing decision of the firm. And they don't seem to be actually more effective in increasing firm value, but institutional investors place a premium on diversity. So if you're a small growth firm wanting to go public, you have to be proactive in diversifying your board or leadership team, and just people won't give you money. So even though you can say this has no economic valuation effect whatsoever, it doesn't matter. It's required. You have to do it. So that is overall what I've been talking about. So it's the idea of trust and soft factors like this are becoming increasingly important in research over the last 5 to 6 years. And so I would strongly encourage people who are interested in these ideas to do research in these areas as well.
Thank you, Professor Rao. Any questions I can see?
I can't hear you, Suman.
Can you hear me now?
You're muted.
Let me.
Can you hear me?
Hold on a minute. My speaker changed. Give me a minute. Okay, just a second over here. All right, go ahead.
Any questions? But thank you very much, Professor Rao. 3 papers, very, very stimulating in ideas. And if you have got any questions, someone asks again that if there is a possibility of measuring the dynamics of trust.
The possibility of what, sorry?
Dynamics of trust.
How would you measure that, though?
I can think of maybe having the survey at different point of time, maybe every year or so.
Yeah, the problem is to find externalities, right? You need to find a way in which this thing is changing exogenously in some way or the other. It's tough. Much of the problems with social science research is, as we know from corporate finance research, it's all endogenous, right? So if you have a change in trust, is that being driven? I mean, how do you have an exogenous dynamic shock to trust? People have looked at this in the past. So for example, an example would be in Japan, when a few banks collapsed, or in the UK, when several banks collapsed. The question was, did that change trust in the UK market, or an instrument is in Japan, for example. But these are few and far between. So it's very difficult to find a trust measure which is enough to capture a change over 40 years. Right?
Yeah. Any question?
We can take it live if needed. I have a question, but I will wait for others if they have some questions, so they can ask live, Raghu.
Okay, so I do see a question here from Jatin, who is saying, how is the role that countries that colonize rule over and the relation with trust? Well, that's actually a bunch of papers by Darren Acemoglu and others who have actually looked at that. So, those papers talk about extractive systems versus in-place systems. So in other words, if I'm somebody from the Netherlands colonizing a country in Africa where the death rate from malaria and other diseases is very high, the institutional system I design in those countries will be very different from a system I would design in America where I'm planning to live and settle down. So, I'm not coming back to the home country, to England. So I insist much more on individual rights, and that creates more trust if within that country. So yes, colonization does have very strong effects on the level of trust within a country. And we have other examples in India as well, where they have very interesting instruments, where in India, for example, the instrument which they used was the law of primogeniture, which basically means that, if your firstborn kid, which your king, was a female, the British take over your empire. right? If it's a male, you continue to be ruling your empire. So because you can't control the birth of your kid that easily, the sex of your kid that easily. So they then compare what happens if the British Empire takes over versus the local Maharaja is allowed to stay in place, and you can do a different type analysis. But these are interesting instruments, and obviously the questions will change. I would highly recommend a book by a guy called Joseph Heinrich, who's called The Weirdest People in the Room. So if you haven't read that already, Joseph Heinrich's professor at UBC, and the book looks at weird people. Who are weird people? Well, Western, educated, industrialized, rich, and democratic. So basically, most of us, right? So it turns out the way you think is very different from the way somebody who would think in China or somebody who would think in Africa, where kin-based relationships are much more strong than the way, than rule-based relationships, which is what we have in the West. So the things we can talk about for trust are very different meanings in the West versus in Asia or in Africa. And so that's something else which research needs to take into account. But as I said, this is a developing area. So I think lots of areas for research here.
Thank you. On behalf of BAFA SEAG conference group members, and we have time, actually no time left for this, but thank you for your presentation, Professor Rao.